It's Mark Yegge here, wealth architect and lifestyle investor. Let's take your life to the next level. Welcome to the Wealth Architect Podcast. Hey everybody, it's Mark Yegge. Welcome to another edition of the Wealth Architect Podcast. So glad you're here. We are back and we are ready to jump into it today with a gentleman who is a Mac Daddy financial planner, certified financial planner, serves his clients as the president and portfolio manager at Libertas Wealth Management Group. It's a NAPFA affiliated fee-only fiduciary RIA firm, registered investment advisor firm located in Columbus, Ohio. Pretty sure he's an Ohio State fan. And he's been named as the Columbus Business First as one of the 20 people to know in finance. He's a recipient of the 40 Under 40 award, which I was back when I was under 40, not anymore. And in addition to his financial advisory role, he's an accomplished speaker, he's an accomplished writer, he's an accomplished educator, and he regularly contributes to numerous financial publications and offers financial planning classes and workshops. Please, let's welcome Adam Koós. Adam, what's up?
What's up? Good to be here. Thanks so much for having me.
Yeah, great to have you. I know you got a lot going on, and you got your I guess your irons in lots of different fires. But let's start up by talking about how you got into this business that you're in today, helping people with their finances and even helping financial planners with their financial planning businesses. Let's talk about all that, how you got here.
It was all an accident. I went to school. I went to Ohio State. You are correct. Let me move here. Here you go.
I gathered that.
I went to school to be a doctor. I wanted to be a trauma surgeon. And it's a long story that I won't bore your audience with, but basically my senior year, I dropped out of the program, kind of didn't know what I wanted to do, kind of went through some personal stuff in my life, and called my dad on walking down the street one day, and I'm like, "Hey, Dad, I've decided I'm, dropping out of the pre-med program. He says, "Why?" And I'm like, "Well, a number of reasons, but I can't go to school for another 7 years, finish my fellowship when I'm 31." He says, "What are you going to do?" And I'm like, "I don't know." I was like, I thought about, doing something in software, pharmaceuticals, but I don't know. I have no idea. And he says, "What about becoming a financial advisor?" And I look at him sideways like he's crazy. I'm like, "Dad, I only took one econ class. I like most of my classes are biology, microbiology, chemistry."
Right.
He says, "Well, you've got that virtual stock exchange account you're always messing around with, and you're really good with people and explaining things and teaching and speaking, and he's like, you're good at making complex things easy to understand. And I feel like most of the people in this business," he's like, "my financial advisor isn't the best at that. And I think you'd be good at it." I'm thinking, where in the world is he getting this idea? So then he tells me, and then this is I guess the closer. He says, "It'd be a lot like being a trauma surgeon, except you'd be doing financial surgery instead of physical surgery." And I thought, okay. So I met his advisor. Still wasn't all that interested, to be honest. And this is maybe where you and I can get into some fun conversation here today. But my problem with the industry was the ethics or lack thereof, the sales aspect of the industry, lots of minutia and lots of, I don't know. I always say what wakes me up every day is saving people from bad advice and bad advisors. And so it took my second meeting with somebody before I realized that they would kind of let me do my own thing. And there wouldn't be some sales manager up here, telling me to sell X, Y, and Z to people. And so I started with a national brokerage firm in 2001, 10 days before the World Trade Center went down. I was 21. I looked like I was 16. I was, uphill both ways in the snow, right? But door to door, business to business, trying to get people to trust a guy who's young with their life savings when, I'm talking to people 2, 3 times my age. So it was a rough
Right.
start, but I think the biggest strength I had was resilience. It wasn't even the execution, like relentless execution was important, but I feel like there's so much failure in any business. And I think that what probably got me through that tough time period when, the World Trade Center comes down, the market's precipitously falling, I'm young, who's going to trust this guy? And, I just kept getting up, every time I got knocked down, I got back up and just wanted to build something that was special and honest and, kind of sift through all the BS that's out there when it comes to the financial news and people, products and things like that, and just take care of people the right way. The way, as my dad put it, just when I started my company in '04, I left that brokerage firm and started my company in November 4th of 2004. And I said, what's one piece of advice you would give me if because he was a business owner himself. He was an optometrist, but he owned his own practice. And he said, just pretend like everything's in tomorrow's front page and the rest will take care of itself. So that's kind of how I built my career.
Interesting. And I don't think you're giving yourself enough credit for the adversity that you went through in the early 2000s because we were just coming off the dot-com crash.
Yep.
We had 2001. We had a 2002 crash,
Hmm.
and that lasted all the way pretty much into 2004, around the time you started your firm. So, there's a lot of ways to look at it. You could have packed up and gone to work for somebody else, or you could have just done what I think you did, and that's buckle down and make it work.
Yeah.
And that makes you stronger. Here you are 20 years later, and you're in a stronger position because you went through that
Yep.
adversity. Would that be accurate?
I think so. Yeah, I think it's accurate. I also look forward from that, like you said about 2003, 2004, '03 was a good year, but you'd have clients that would say, "Hey, well, it's our annualized performance since '01." And of course it was like point 0.5 or if
Right.
it was positive at all, depending on when they started with me. So I think when I look back here, 24 years now I've been doing this. The 2000s and the 20 teens were a tough market.
Sure.
Two of the biggest crashes in history. You know, now we had COVID right there in 2020. So if there was a time to learn how to do it and be challenged as much as possible, those 2 decades were the 2 decades to do it.
Yeah, no kidding. And so that got you in. And what do you like about doing this? So you help a lot of people with their finances, and you help try to steer them in an ethical way, as you said. So
Mhm.
what is it that really floats your boat when it comes to helping people with their finances? Is it the future? Is it that you have a different strategy? What is it?
I think honestly, it's kind of like we might have said this off air. I can't remember, but I know I think we were on air when I said what gets me up every day is saving people from bad advice and bad advisors.
Yeah.
I you can't save everybody, right? I hate those phone calls or the people you meet when you do an intro call with somebody, and you find out that some person put them in some annuity with a 15-year surrender on it with a
Yep.
penalty of 10% to get out,
Yep.
and they want your help, and you're like, look, I can help you with some advice, but as far as investments go, I can't. I mean, I'm not. I can't in my right mind tell you to sell this thing at this point. I mean, for those that don't know, there's a 45-day free look on most of these things. So if you're listening or watching right now and you got into something you don't want in the first 45 days, you can get all your money back without any penalty. And if I were you, I might consider that option, by the way. But I digress. So,
We agree on the whole annuity thing then.
I mean, I always say annuities are not bad investments. They're good investments for some people for some of your money. The problem with annuities is I think the people who sell them think that they're the best investments for all people for all your money,
Yeah.
and it's because the insurance industry is not regulated very well at all, and they're paid. There's revenues, bulletin boards, and contests that they'll have where who's sold the most premium or something like that,
Right.
and it's just that's not thinking about the client here. That's how much commission did you make this year based
Right.
on how many annuities and insurance you sold. I don't know that should be the litmus test for how successful your client base is, but anyway, again, I digress. So yeah, I mean, I think that what gets me up and what pumps me up all the time is just giving people the truth and helping people like whether it be with our wealth management firm Libertas, helping them figure out when they'd like to have the choice to make work optional, and then once they become retired, staying that way with our business transition and exit planning firm. It's called Elevate and Exit. So with Elevate, it's helping business owners who are within 3 to 5 years of selling, increase their relative value, their absolute value, get the business owner out of the business, de-risk, and sell it for more money so they can ride off into the sunset, back to retirement again, right? Just a different way. And then you mentioned financial advisors. We don't have to talk about that today, but helping other advisors do the same so that we can, you know, I want to help more people, and if there's one way to help more people, it's by helping advisors help people, right?
Sure.
And the right way.
Hey, it's Mark Yegge here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. Now, while 2 to 4% a month doesn't sound like much, I show you exactly how we took my IRA from $111,000 to over $500,000 in just 19 months without huge risk. I'm not telling you this to brag, just to show you that you could do this too. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io, and you can learn more.
So somebody's listening to this and they're, they got a couple $1 million portfolio, for example. and they come to you and they say, how can you help me? I know you're going to ask a bunch of questions, but in general, kind of what is your approach?
Sure. I mean, our approach is we start with planning. We won't work with somebody who doesn't want to do a plan, period. If they're like, oh, let's just say this has happened before. I've got, 12 million. I've done my own spreadsheets. I don't need a plan. I just want you to invest my money. We won't work with that person. So it's not about money. It's about giving the right advice. I mean, somebody who's got $12 million might not need a retirement cash flow analysis because they're not spending enough money,
Yeah.
but they've got tax problems. They've got estate planning problems. You know what I mean? There's other issues there, and there's stones that are unturned that need to be turned over.
Yeah.
So I'd say that, the first step is, like you said, we do a 2.5 hour discovery meeting, and sometimes it's longer for business owners. Then we do an education meeting for an hour, and then we do a financial planning meeting for about an hour and a half. That gives all the recommendations, cash flow analyses, tax planning recommendations, estate planning, insurance from top to bottom. And then from there, if we decide to work together, which, about 85 to 90% of the people who go through that process hire us, then we move on to a 6-week follow-up meeting. We get them introduced to people, who other people can help them, like attorneys, CPAs, insurance agents, M&A brokers, business bankers, and so on. And we just kind of keep the momentum going. So that would be our approach from a planning standpoint, and from an investment management standpoint. I'm one of the few chartered market technicians out there. So we have 18 model portfolios. 10 of them are buy and hold. I hate to use the phrase buy and hold, but they stay in the market all the time. They're relative strength based, which means in layman's terms, I always say the way it works is the portfolios are invested in either ETFs or ETFs and stocks. And the way they're invested is, picture if all the teams we could buy, or all the investments we could buy in the world, were the teams in the NFL. We're just buying the playoff teams. We're not trying to bet on the NFL team. I'm sorry, we're not trying to bet on the Super Bowl team, but we're not just diversifying, across all the teams, which is, in my opinion, not a good idea.
I agree.
We're just buying the playoff teams, and then, as the season moves along, if a team has a 2-game losing streak, that doesn't mean they're not making the playoffs. It just means they had a losing streak. But if they start getting bad enough to where it looks like they're not going to make the playoffs, then, we eject them and put somebody else in the portfolio. The other 8 models are trend following models. So they have the same invest with the playoff teams concept, but on top of that is a trend following layer where when certain levels are hit for each investment in the portfolio, we'll cut bait and just go to cash. And we'll let the market tell us what to do. So if we're risk on and, pedal to the metal like we are right now.
Right now,
then
yeah.
great. If it's like it was at the end of February, you start seeing the market breaking down, you start individual stocks break down. 2022 is a great example. I mean, we were probably 74% cash in those models through that whole market. But what was interesting is what we owned. We still owned oil, we still owned some commodities, and we owned some energy stocks, because that was the only thing going up. Stocks
Sure.
going down, tech's going down, bonds are going down. So it's a matter of just, staying invested in what's going up. I hate to say it as simply as that, but that's really what it's all about. There's nothing
Right.
wrong with buying all-time highs.
So, I mean, it sounds like you're a market-centric kind of a planner. Is there room in there for real estate? Do you talk about that? Is that something you get involved in? And what other kind of assets do you talk about? Because it's obviously more
Yeah.
than the market, right?
I would say that we'll talk about real estate last. The second probably big, aside from your traditional investments, would be your structured notes. Like we use a lot of what's called absolute return buffer dual directional notes, and the way they work is, let's just use a simple money goes in the market today. What is it? 21st of June, July, 21st of July. I don't even know what date it is. And a year from now, that investment's going to mature, say a year and a day from now, to keep it long-term cap gains. And the way it works is it's tied to an index. Let's just say it's tied to the Qs, the Nasdaq 100. A year from now, if it's got a cap and a buffer, the cap's above our head, so it's like a ceiling. If the cap's, let's just say 15, a year from now, if the Qs are up 14, we make 14. If it's up 20, we make 15. We're capped at 15.
Got it.
But if it's down, the buffer would traditionally be 10%. So if it's down 5, we get the absolute return of that negative number down to 10. So if it's down 5, we would make 5.
Okay.
If it's down 9.9%, we would make 9.9. And then if it's down 11, we'd lose 1. So our risk is limited to the amount lost below that buffer. So we use those investments. And then from a real estate standpoint, we do a fair amount. You can probably see it on our website, libertaswealth.com. There's the first drop-down menu says DSTs and 1031s. So we do a fair amount of business with clients who are looking to it's one of two clients typically. It's either a business owner who sold their business And usually business owners have real estate, commercial real estate that they, that's like their office that they were an owner occupant.
Right.
That's the first type of client. And then the second type of client is your client who's built a nice portfolio of residential real estate over the years. And they've got a nice, nice just cash flowing portfolio. Sometimes there's debt. Usually there's no debt. And the issue, of course, is cap gains. And for those folks, what we're doing is we're using, it'll be the business owner says, look, I don't want to own this thing anymore. I'm just done. I want to be really retired. And for the residential real estate portfolio, usually what we hear is, hey, I love this thing and I'm proud of it, this portfolio, but my kids don't want it. Like when I'm
Right.
gone, they don't want to deal with it. So what we'll do is we'll 1031 it instead of into another property. We'll 1031 into a Delaware statutory trust, institutional grade properties like storage units, medical office buildings, senior living, any number of sectors. We let them choose, but we do the research and show them, a bunch of different options. And then what ends up happening is they sell the properties. They're no longer a landlord. They don't have to deal with the three T's, the toilets, tenants, trash.
Yep.
And then when that property sells, they can just 1031 again and again and again. And when they pass away, it steps up in cost basis at their death, so the kids never have to pay tax, which is pretty freaking cool.
That is very cool. That's really great. Is there room in your analysis for alternative assets like cryptocurrency, Bitcoin, things like that?
For sure. Yeah, I think that Bitcoin and Ethereum are here to stay. I think they're the new asset class. The asset class used to be U.S. stocks, international stocks, fixed income, currencies, commodities, and cash. That's six. I think the seventh is now digital assets.
Yeah.
But I do think that if you're going to invest in crypto, I think that you have to either be young and let it go and really, somebody who's okay with risk, or B, if you're somebody who's older and maybe not as risk, you're more risk averse, then I think that you've got to have a trading strategy for it. I don't think it's kind of like the people that'll say to me, "Oh, if I just had Amazon since day one," and it's like, well, yeah, but you would have had to see that thing go down and crash 16 times.
Exactly right. And I don't know anybody that's still in Amazon or Apple or Tesla that started 10
No,
years ago. There's nobody.
no, no. If they are, they're in a coma, and so yeah, I think crypto is going to get bigger and bigger, and I think it's going to go through cycles just like any investment. Right now it just broke out, a couple weeks
Yeah.
ago,
Yeah.
and Ethereum's actually talking about playoff teams. Ethereum's actually the stronger performer of the two. So I think that as long as you're using a strategy that aims to stay in whichever asset or digital asset that is the strongest, and then when the market's falling, rolling over and falling, I think you probably want to get out.
Yeah.
But that's just my opinion. I have no shortage of opinions.
Well, you and I both, but that's okay. That's what makes the world go around, right? We may not agree, but we got opinions. So, as we kind of cruise into the final here, what would you say, somebody's sitting out there, they don't have a financial planning strategy. They watch some YouTube videos about how to invest. What would you say to them? Where do they start?
Hmm. Okay, that's a good question. I would I would say that podcasts and YouTube videos and shorts are great. I would caution you with the short form content. I think a lot of that's meant to hook you, and
Sure.
it's more marketing than anything. Even if somebody has nothing to sell, I think it's still like it's punchy. It's more about the excitement, and I believe that long term serious investing shouldn't be all that exciting. If it is, you're probably not doing it right.
Yeah. Yeah.
So I think that books would be the best way to go. I think that you kind of have to. The first thing I always tell people is you got to know your time frame before anything. So and when I say time frame, I don't mean like how long I'm going to keep this, or when I'm going to spend the money. The time frame is more along the lines of, over what time frame do you feel like you want to hold an investment for an average period of time? And most people I think would say, well, I'm just going to keep it for a long ass time. I'm just going to keep it for forever. It's like,
Yeah.
okay, that's fine. If that's the case, then I'd probably stick to ETFs, major market indices, build a diversified portfolio. As much as I hate saying that, but I mean, I always say that you have to have two things. If you're going to invest your own money, which people can, you don't need a financial advisor, that's for sure. But you have to have two things. A, you have to have the interest in it, and B, you have to have the time. And the problem is most people don't have the interest, and so they don't spend the time on it, and then they don't like their results.
That's right.
But even those people who are interested in it, many of them are just too busy doing whatever it is they do for a living, being a mom, a dad, a husband, a wife, whatever. and so don't spend the time on it because they're just busy. And
Yeah.
so even for those people, it's like, you need to seek out some help, I think, at least some help. But for those people that love it and they can allocate a little bit of time to it each week or each month even, I think that, reading a couple good books, and then just building a strategy that makes sense for you and putting some rules in place and follow the rules like a robot. Don't be emotional. We're humans. Humans are terrible investors. So we've got these brains that get in the way all the time.
We sure do. Emotions do get in the way of solid, intelligent investing. So where can people find out a bit more about you, Adam, and where can you send them?
Yeah, if you're not a business owner, then libertaswealth.com is the best place to go. If you are a business owner, you can head up if you're interested more in the retirement planning and investment management side at libertaswealth.com as well. Or if you're one of those business owners, like I mentioned, that's kind of looking to increase the value of your company, de-risk, and sell someday, then elevateandexit.com. So elevateandexit.com is where I would send people. And of course, LinkedIn. You'd always go to LinkedIn.
Got it. Well, listen, I think your dad did a good job in steering you in that direction after you had that crisis to be like, wait, I don't want to go through another year, 7 years of this. I think he did all right. So
Huge
seems like,
compliment. So thank you for that.
yeah, thank you. Listen, thank you for your time and your wisdom. And everybody else who's listening and watching, remember what I always say, never give up your power in your health, your wealth, or your time. See you next time, everybody. Have a great day.
You've been listening to the Wealth Architect Podcast with Mark Yegge. Follow us on iTunes, Spotify, or wherever you get your podcasts. Like and subscribe on YouTube. Share and tell your friends. See you soon.